Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Tuesday afternoon. I'm Juliet Sarley. Great to have your company on a day when we did see a little bit of a pullback coming through, although the CBO 200 there finishing the day fairly flat. The ASX 200 a little bit weaker as we head into match off, but only down about 0.1%. Of course, we had weakness coming through from the financial sector today, really weighing on the overall market. The CBA sell-off certainly dragging down the financial sector, which was down by close to 2%. But other than that, it was pretty solid when you look at the utilities, the energy stocks, material stocks as well. The US Senate approving this deal to end the historic shutdown, likely to give a little bit of boost to risk sentiment. And of course, we've been closely watching what's been happening with the gold miners and lithium producers. Spodumene above $1,000, which is very much supporting those lithium players. Let's so get to the themes of the day, and it certainly has been the big bank blues, heavy selling in the CBA, very much dragging the market lower. We'll get to that with our guest Martin Crabb, of course, from Shaw and Partners, back from holidays, but CBA reported a $2.6 billion cash profit in the September quarter. Operating income was up 3%, operating expenses also higher, and that was mainly due to higher wages and IT costs. The spending spree, meanwhile, as we look at consumer sentiment picking up, and then, of course, we look to the opening up of the US government after this historic shutdown. I think we saw something like 2 non-farm payrolls data not being released due to the historic shutdown. Let's have a look at the financial sector, which closed lower by close to 2%. Wow, that 6% drop coming through from CBA today. UBS, I was at the conference in Sydney. Look, they are underweight financials as a whole. Westpac is their preferred bid. We spoke to Richard Shellback and also their banking analyst, John Story, about the banks. You can catch both those interviews online, ausbiz.com.au, but certainly CBA was a big seller and lag on the overall market. The miners there, a bit mixed. Rio's pretty flat. BHP was up 1/3%. South32 down 0.8%. And MinRes had a good session, up by about 0.6%. And I mentioned a lot of money going into the gold stocks today. Richard Shellback from UBS also likes Newmont. In fact, Newmont, Westpac, Telstra, his 3 top preferred picks in the top 200. Northern Star also looking good, up 3%. Evolution Mining there up by about 2%. More on CBA there. Softness in the first quarter margins. They had higher costs. Also at Bendigo Bank, reporting unaudited cash earnings of $120.7 million for the September quarter. Shares there hit hard as well, down by 8.2%. Now, we are hopefully going to chat to Life360 in the next couple of days on the back of their numbers, lifting revenue and earnings guidance for the full year as it's due to acquire Nativo, which is the online advertising company, for around $120 million, but certainly big sell out of shares today, down by about 5%. Cromwell Property, pretty flat on the close, but it is expanding its Australian industrial portfolio. And Jumbo Interactive lower as it flagged a lower dividend payout ratio. Let's welcome back to the COB after his holidays, Martin Crabb from Shaw and Partners. And you've come back on a pretty flat day. What did you make of the banks and CBA there being
Yeah,
flat?
they were definitely the story of the day. I mean, CBA is around about 11% of the ASX 100 index, so a 6% move, and that's almost 1% on the index. We also had an ABEX dividend today, so they paid, I think, an 86-cent fully franked dividend. So that's going to take a buck off the share price as well. So it's only a quarterly from the CBA. Sorry, they are a June balance, unlike the other banks, which are September balances. So they don't give you all the detail. But obviously the market really didn't like the negative jaws. So this is where costs go up faster than revenue. So the ANZ CEO spent a lot of time yesterday talking about cost out opportunities. There's obviously a lot of stuff he can take out. Commonwealth Bank's known to have the best tech stack and the best customer service. So you'd expect them to be more aggressively taking costs out using AI, etc. And the fact that it had a 6% increase in costs got the market very worried. Bendigo is the other notable one, down 8%, and purely on the competition in the sector. It's really heating up. Westpac talked about this. ANZ talked about this. You can get a mortgage for about 1.2, 1.3% above the cash rate, a fixed rate mortgage at the moment. So It's super competitive. The charts we've got up on screen there are just looking at the differential that ANZ and CBA have. So in earnings terms over the past decade, neither have really grown earnings. CBA has grown earnings by 10% over 10 years, and ANZ's probably flat over 10 years. You don't own these stocks for growth. They tend to pay out, 75%, 80% of their profits as a franked dividend, only leaving enough capital to grow the business in line with the economy. So they tend to issue shares to do that. So they're not really growth stocks. The premium that CBA trades at over ANZ went all the way to 135%. So that's the PE ratio of CBA. It was 135% above ANZ back in June. It's now 65. So there's been a massive reversal of fortunes. Some of that was today, right? So ANZ was up and CBA was down. So we've seen a rotation in leadership from CBA to the other three banks.
I mean, as you say, when CBA is down that much, you're not going to have, a very positive session on the market. So the fact that we're pretty flat, I guess, is a good outcome.
Yeah.
In terms of more broadly, when we look at earnings per share revisions, what are you seeing in terms of total shareholder return?
Yeah, it's been interesting. The market's sort of been bouncing around, what we describe as fair value, and how do we derive that? We just take the consensus target prices of every analyst in the market for every stock in the market and calculate a fair value level for the market. So this is saying if every stock in the market traded at what the analyst thought its fair value was, where would the market be? And then we compare what the market's actually trading at. And the difference between the two is your capital gain. You then chuck your dividend yield on it and you get your TSR, your total shareholder return. Now that's been bouncing around 2 or 3%. You can see the black line there is the market's estimate of fair value. And that's been rising. So analysts have been upping target prices, all the way from pretty much the lows in April. We've been upgrading, and that's been because earnings have been upgraded as well. And yet the market's gone in the other direction. We all talk about this K-shaped thing. The fair value has been rising, but the market itself has been coming back, and that's created some value. And that value is purely reflecting the improved sentiment around earnings. So as you mentioned earlier, people are spending money. The economy's recovering, interest rates are coming down, wages have been good, tax cuts have come through. So there's been a general improvement in economic circumstances, and that's led analysts to increase earnings estimates, which has then moved target prices higher. And so we now have a TSR around about 9%, which is pretty attractive considering alternative investments out there. So that's why the market's been moving higher. It's just been on earnings revisions.
We were talking outside about the fact that the UBS conference was on. I was there. We heard from Larry Jedlow from TIS Group speaking to me today. He's very bullish on Australia. Richard Shellback also bullish on a momentum, the melt up, he was saying, continuing for the next 18 months. And what I found was interesting was that he was saying one of the reasons why we shouldn't think the market will pull back is, the rate cutting cycle could be near the end. We sort of heard that from Andrew Hauser yesterday as well at the conference.
Yeah, it seems like the Reserve Bank is concerned there's not enough slack in the economy, and so any recovery in growth is just going to cause more inflation. The interest rate markets have completely marched away from any rate cuts. So as you can see, the red line there is the futures pricing as of 3 o'clock today, and we're not looking at any. We're looking at probably a 2/3 chance of maybe one cut sometime next year, like this time next year. So you can almost forget about it from the market's perspective. So we're at neutral now at 3.6. We're at neutral, and that's because and George Theranos at UBS is saying this as well, is that the economy is so resilient and the inflationary pressures are still evident. It's impossible for a central bank to move rates in that scenario. The only thing that would change that dynamic is a significant deterioration in the labour market. We do get stats out on Thursday. We get unemployment in Australia on Thursday. That would have to materially weaken. Now, what we're hearing from companies is not that. We're not hearing the big layoffs. A little bit in the banking side, a little bit here and there, but generally speaking, the economy is still short workers and companies are still looking to hire rather than fire. So I think unless that narrative changes, the fact that inflation's above the RBA's target band, they can't really cut rates. Even though they admit they're probably still restrictive, they think that's the right place to be. So not good news if you've got a mortgage, but good news if you're an investor.
And good news, I guess, for the overall economy, right?
Yeah, that's right.
All right, Martin, great to have you back. Thanks so much, Martin Crabb there from Shaw and Partners. Well, getting back to stock specifics and looking at what we discussed on the call of the call of the day was Live 360. Andrew spoke to Michael Wayne from Medallion Financial, Jonathan Takadina from MPC Markets.
Hard to decipher today whether it's the update itself or whether it's the acquisition that was announced that's causing the share price weakness, or perhaps a combination of the both. Because obviously they are paying up for this business and they haven't really disclosed whether or not it's going to be EPS accretive or not. The market likes these acquisitions when they are EPS accretive and probably doesn't like the fact that there hasn't been much clarity provided as of yet. I don't know if there's been some comments since that I've since missed, but yeah, it'll be good to get a little bit more colour as to exactly, the benefit of this acquisition, or whether it's going to be a expense carried on the balance sheet for some time.
I think it's actually the acquisition. So their quarterly revenue is about 125 million, which is what they spent on this acquisition. And there's no clarity in the announcement on what they're going to use the acquisition for. Is it so? From what I understand of Nativo, it's like they're going to target more ads. So are they going to then produce more ads within the actual app itself to help drive revenue? That could work out well. Or are they using it to actually advertise 360 more on other platforms? That's where I'm not so clear on.
All right, flat day on the market. Let's have a look at some of the leaders, though, in today's session. Light & Wonder up by an impressive 11%. We talked about spodumene prices spiking above $1,000 sending lithium stocks higher. PLS up by almost 8%. Liontown up by 7%. To the downside today, well, we touched on Bendigo and CBA. Martin giving us his thoughts there. Life 360 as well was the stock of the day. And IperionX and Lovisa also laggards today. In the small end of town, Canyon Resources, Serco, Mayfield, Caravel Minerals and Lumos Diagnostics had a good day, while the laggards in the small end of town actually included some of the lithium players, which is interesting. European Lithium down by about 16%, also had some weakness coming through in Waratah and Archer Materials. Tonight, well, I guess we're also closely watching the thoughts here that the Senate has approved the deal to end the historic shutdown, but the US NFIB Small Business Optimism Index, again, potentially delayed if we do not see an end to the shutdown. Tomorrow, CBA household spending insights for October, due lending indicators for the September quarter, with the value of new home loans expected to lift by 4%. Full year results include Aristocrat Leisure, while we have AGM season continuing with Domino's, Jumbo Interactive, Netwealth, and ResMed will be trading ex-div. The market pretty flat there on the CBO 200. Let's give you a quick look at where the ASX 200 has finished, and it's actually sold off even more into the close. So down 17 points, or 0.2%, to 8,818.8 points. No surprise there that Bendigo and CBA did drag it lower. But look, if you've got CBA shares down by some 6% and you strip that out, I'd say it's not a bad day at all indeed. We'll see what the potential reopening of the US brings in terms of optimism, and do it all again from 9:45 a.m. Eastern tomorrow. We'll see you then.